Look around. Everything you see, the skyscrapers, the roads, the phone in your hand, was bought, built, and powered by money. You work for it, you save it, you spend it. You believe it represents value earned. But what if I told you that the very foundation of this entire magnificent world is a paradox? A simple, invisible mechanism that ensures one immutable truth. There is never enough money to pay off the debt. It's the central lie of the modern economy. And it's not a conspiracy theory, it's a mathematical certainty built into the system by design. The moment a loan is issued by a bank, two things are created simultaneously: the principal, the money you borrow, and the interest, the fee you must pay back on top of it. The principal exists. The interest, however, it does not. The money to pay the interest must be pulled from the money supply of other loans, from other people, or from future debt. The system demands that for a few to thrive, the many must continually compete for a supply of money that, by definition, is always smaller than the total obligation. Who created this system? And why? This is the story of the invisible bankers, and how they quietly engineered a world where the interest search is the true engine of civilization. A world that only survives as long as we can take on more debt.
We are going to trace this financial DNA from its medieval origins to the modern Federal Reserve. We will uncover the true purpose of the gold standard's collapse and reveal the 3 key decisions that cemented the current paradigm. By the end of this video, you won't just understand economics. You will understand the fundamental mechanical tension that drives every boom, every bust, and every global conflict. But first, we have to go back, way back, to a time before banks, when money was a concept, not a promise. The gold, the goldsmiths, and the shift in power. The story begins not with central banks, but with gold. In 17th century London, merchants needed a safe place to store their heavy, valuable coins. They went to the goldsmiths. The goldsmiths issued a receipt, a piece of paper, promising to return the gold on demand. Crucially, these receipts began trading hands as if they were the gold. They were the first form of paper currency. Here's the twist. The goldsmiths, observing that only a fraction of people ever claimed their gold at once, realized they could issue more paper receipts than the gold they actually held. This was the birth of the fractional reserve system. 100 gold coins enter. The goldsmith lends out 900 receipts, new money, backed by the promise of just those 100 coins. They charged interest on this newly created debt, and here is the key. The moment the world changed, they were not lending their own gold, they were lending the promise of gold they didn't possess. They had effectively acquired the power to create money out of thin air, leveraging a small physical base into vast financial power. They went from being storage caretakers to the architects of the money supply. This inherent leverage, the ability to collect interest on money that only exists as a ledger entry, is the engine we are tracking. It's what allowed these invisible bankers to eventually formalize their power. The biggest leap happened in 1694, with the founding of the Bank of England. It was ostensibly created to finance a war, but its lasting legacy was institutionalizing the fractional reserve model under government charter. Now, the private right to create money via debt has become a national power, controlled by an elite few. The system was now officially dependent on perpetual growth and perpetual interest. Remember this moment, because the first act of the invisible bankers was to sever the link to gold completely. That final, catastrophic break is what sets the stage for our current financial reality.
For centuries, even with fractional reserve banking, a hard commodity like gold or silver acted as a limiting break. The quantity of metal was the ultimate constraint. The pivotal move that set the modern stage was the Bretton Woods Agreement of 1944. In exchange for backing the global financial order, the United States dollar became the world's reserve currency, pegged to gold at $35 an ounce. Other countries pegged their currencies to the dollar. This looked like stability, but it was an illusion. It meant the U.S. Federal Reserve was now the de facto invisible central banker of the world. It could export its debt-based dollars globally, and as long as foreign nations trusted the U.S. promise of gold, the system worked, but the math, as always, was hostile. The U.S. was issuing far more dollars than the gold in Fort Knox could ever cover. The interest problem was simply moved to a global scale. The breaking point was inevitable. By the late 1960s, foreign governments, particularly France, grew suspicious and started demanding gold for their dollars. The U.S. gold supply was draining. On August 15, 1971, President Richard Nixon delivered the ultimate twist. He unilaterally suspended the convertibility of the U.S. dollar to gold. The Bretton Woods system was dead. This was the final, critical act by the invisible bankers, the complete severing of money from any physical constraint. Suddenly, the money supply was backed by only one thing: the promise of future taxation and the faith of the people. Without the gold anchor, the world entered the era of fiat currency. The power to create money, to create principle, but not the interest, was now purely legislative. Central banks could print money indefinitely, limited only by inflation, ensuring that the necessary amount of principal was always available to cover past interest payments, but only by incurring new interest obligations. Debt became the system's primary lubricant. See, breaking point, the great financial crisis. The interest-based, debt-driven machine ran on overdrive for decades. The invisible bankers realized that to keep the engine fueled, they needed new, creative ways to generate debt, leading us to the 2008 great financial crisis. The cause was a direct outcome of the system's nature, the need to constantly find new debtors willing to pay interest. This led to the creation of complex, exotic debt products, the infamous collateralized debt obligations (CDOs). Banks packaged subprime mortgages, loans made to people who couldn't afford them, but who paid high interest, and sold them as safe investments. When interest rates rose and the marginal debtors defaulted, the entire pyramid of debt, a pyramid built on the phantom interest that didn't exist in the money supply, came crashing down. It wasn't just a housing crisis, it was the systemic failure of the perpetual interest model. The problem wasn't bad loans, the problem was the mathematical imperative to create debt faster than it could be serviced. Fallout and failed fixes. The QE trap. The response to the 2008 crisis was the ultimate failed fix. Instead of addressing the core problem, the inherent scarcity of principal relative to total debt obligation, central banks doubled down. They introduced quantitative easing and dropped interest rates to historic lows. Meant the central bank bought assets, mostly government and mortgage bonds, from commercial banks, injecting trillions of new, principal-only dollars into the financial system. Low interest rates were supposed to encourage borrowing and investment, but what did this fix actually achieve? It did not flow into the real economy of wages and small businesses. It flowed directly into asset markets. It inflated the value of stocks, bonds, and real estate, leading to the largest wealth inequality gap in a century. The central bank effectively became the beer of last resort for debt, meaning the interest problem was not solved. It was simply transferred from private banks to the public ledger. The system was saved by a massive increase in the very thing that caused the crisis: debt. This was the final, irreversible step into the interest-driven economic purgatory we live in today. The endgame, the history lesson, is over. Now, let's look at the present, where the chickens of 1971 and 2025 have come home to roost. The pattern is clear: debt begets more debt, and interest is the inexorable tax on the future. Shocking data points: the reprogrammed economy. 1. Zombie companies. The interest-based system is supposed to cull weak companies. Yet, today, a vast number of corporations, the zombies, are so laden with debt that their profits aren't enough to cover their interest payments alone. They only survive because interest rates are kept artificially low. This is a sign of a fundamental metabolic failure in the economy. 2. Sovereign debt tsunami. Nations are now caught in the same interest trap. The U.S. national debt is nearing $35 trillion. But watch this. A significant and rapidly growing portion of the federal budget is now dedicated not to schools, defense, or infrastructure, but simply to paying the interest on the past debt. We are funding the future by servicing the past. 3. The housing paradox. Home prices in major cities are unaffordable, yet the interest rates needed to pay the mortgage mean only a small fraction of the population can qualify. This is the invisible tax of the interest system at work. It creates asset inflation for the wealthy, the ones who hold the assets, and debt bondage for everyone else. We are seeing the patterns repeat with sickening familiarity. Every boom, from the Dutch tulip mania to the 2000 dot-com crash, is fundamentally the same story: excessive creation of credit debt seeking an interest yield. leading to asset mispricing, followed by a violent and painful correction when the cash to pay the interest simply runs out. The invisible bankers didn't need to conspire in a smoky room. They simply needed to engineer the system itself. And they succeeded. The world runs on interest. Conclusion, takeaways, and warning: the question is not if the music will stop, but when the debt requires an interest payment so large that the central banks cannot print enough principal without destroying the currency itself. Here are the 3 clear takeaways to navigate this reality. 1. Understand money creation. Money is debt. Every dollar, euro, or yen that exists was born as a promise to pay it back with interest. This knowledge shifts your perspective from seeing saving as good to seeing debt avoidance as essential survival. 2. Prioritize asset ownership over cash, because the system requires perpetual debt creation. Money printing to pay off perpetual interest, your cash will inevitably lose purchasing power over time. The only way to win is to own real, scarce assets like land, commodities, or equity that rise with the money supply. 3. Recognize the political incentive. Politicians are incentivized to create debt principle to finance spending, because the inevitable pain of paying the interest is always deferred to the next administration. Vote for fiscal responsibility, not spending promises. The warning is simple: this system has an expiration date. It is mathematically impossible for a system built on perpetual compounding interest to exist in a finite world. The only possible end is a reset, a default, or a currency collapse. When the debt is too large to service, who will the invisible bankers choose to bear the loss? Will it be the governments that printed the money, the debtors who borrowed it, or the savers who trusted the value of their currency? The answer will define the next century. Affected economy. At present, the economy most severely and immediately affected is the United States, due to the US dollar's status as the global reserve currency. Present-day negative effects in the US: unsustainable debt service. The US national debt is rapidly increasing, and as interest rates rise, the cost of servicing this debt is becoming one of the largest expenditure items in the federal budget. This crowds out productive public investment, for example, infrastructure, education, and represents a significant tax on future generations. Extreme wealth inequality. The post-2008 failed fixes KNZARP disproportionately inflated asset prices, stocks, and real estate while suppressing returns on savings. This cemented the largest wealth gap in a century, as wealth is compounded for the asset owners while the majority is forced into debt bondage. Proposed solutions to alleviate the negative effects. Solution 1. Fiscal policy reform targeting the source of debt. Implement zero-based budgeting across all federal agencies, requiring full justification for every dollar spent annually, rather than simply basing the budget on the previous year's spending. This should be combined with the binding, multi-partisan debt reduction mandate to significantly reduce the national debt to GDP ratio over a fixed period. Solution 2. Monetary policy shift targeting stability. Adopt nominal GDP and GDP targeting to replace the current system of targeting inflation and employment separately. And GDP targeting aims to achieve a stable, predictable path for the total size of the economy, giving businesses more certainty and potentially reducing the central bank's impulse to resort to drastic, asset-inflating measures like QE. Solution 3. Incentivizing equity over debt. Addressing the systemic bias. Reform corporate tax laws to reduce the incentive for corporations to use debt. For decades, interest payments have been tax-deductible, effectively subsidizing debt creation. Removing or severely restricting this deduction would encourage companies to raise capital through equity financing, selling shares, and sharing risk, reducing systemic leverage and financial fragility.